Puts on Oil by www.options-trading-education.com. Puts on oil outnumbered calls recently as options traders anticipated a fall in oil prices. As those engaged in euro options trading are aware, industrial production in Europe, China, and North America is down. As industrial production falls, so does oil consumption. Options traders use puts on oil in order to leverage their investments and to limit investment risk. Oil futures have fallen after a period of high volatility. This is consistent with a high degree of market speculation. It would appear that the general consensus of traders is that oil will continue to fall. Thus, puts on oil continue to outnumber calls. The International Energy Agency has stepped into the picture with a promise to help coordinate the release of petroleum from stockpiles. The price of oil is currently falling because supply exceeds demand. With a release of energy reserves, supply will more greatly exceed demand, and the price of oil will likely fall farther, making today's puts on oil profitable. When to buy puts on oil or other commodities, stocks, or futures is when the trader expects a fall in price. Many factors are at work in this situation. A fall in industrial production has caused a reduction in oil demand and oil prices. A large amount of debt has been taken on by many nations in an attempt to raise employment and lift their economies out of the recession. Thus, sovereign debt weighs heavily on many economies. The Greek debt crisis is a case in point. The need to bail out the Greek economy has put the euro in a recurring tailspin. Money diverted to pay debt is not available to stimulate economies. An additional factor is the ability of the oil-rich nations of the Middle East and North Africa to produce oil. While industrial production lags across the globe, civil war rages in the oil-producing nation of Libya. Civil and political unrest also plays itself out throughout the Middle East. To the extent that political unrest turns into civil distress and civil war, the oil-producing capacity of this region will be threatened. If that happens, worldwide production might fall. The price of oil might go back up despite reduced demand. This is why many smart traders buy puts on oil instead of directly buying or selling oil futures. So, how do options work on oil stocks or oil futures? A trader buys puts on oil futures or oil stocks. He pays for the right to sell a futures contract or the stock on or before expiration of the options contract. He is under no obligation to do so. If the price of oil futures or the oil stock involved falls in price, the trader has two options. First of all, he can execute the options contract. He will borrow to buy the now lower-priced futures contract or stock. Then he will execute the contract and sell the stock. The difference between the strike price and the spot price will be his profit, minus fees, commissions, and the options premium. His other choice is to make the opposite trade in order to exit the options contract. He does so and pockets his profit without ever owning stock or holding a futures position. For more insights and useful information regarding options and options trading, visit www.options-trading-education.com.